In the last 18 months alone, HDFC Flexi Cap Fund has added over 28,000 crore in assets, taking its total AUM to 75,000 crores. It's not just one of the largest Flexi Cap funds in the country, but also one of the fastest growing. In 2022, Roshi Jain took over the fund's reins from legendary fund manager Roshi Jain, marking a major shift in its leadership. So what's changed since then? How has the fund's performance changed over the years? Is it worth investing now? Hello and welcome to our channel 5-Minute Finance by ET Money, where we simplify the basics of investing and personal finance. In this video, we'll talk about how HDFC Flexi Cap manages risks, deliver returns, and whether it is the right fit for your portfolio or should you stay away. But before we begin, please note this is not a fund recommendation. Please do your own research if you wish to invest in it. This video is just for educational purposes. Let's start with a brief overview of the fund. Launched in 1995, HDFC Flexi Cap Fund is the oldest fund in the Flexi Cap category. It was originally launched as HDFC Equity Fund. Back then, it followed a multi-cap approach. Now, the definition of multi-cap back then was what we call today as Flexi Caps. That is, they could invest across large, mid and small cap stocks. But then in 2021, SEBI introduced new guidelines for multi-cap funds, requiring them to invest at least 25% each in large, mid and small cap stocks. So HDFC Equity Fund, previously a multi-cap fund, was reclassified as a flexi-cap fund to align with the new regulations. Flexi-cap funds, as defined by SEBI, can invest across market caps as per the fund manager's choice. Today, it manages over 75,000 crore in assets, making it the second largest flexi-cap funds in India, right after Parag Parikh Flexi-Cap. Now, in the last 6 months, HDFC Flexi Cap has added nearly 10,000 crores to the AUM, a clear sign of strong investor interest. The fund is currently managed by Ms. Roshi Jain, who took over in 2022 from veteran fund manager and the then CIO of HDFC Mutual Fund, Roshi Jain. Dhruv Mochal is the co-fund manager. Look at the numbers on your screen. A quick look at the 3, 5 and 10-year trailing returns of the fund reveals it has consistently outperformed both its benchmark and the category with considerable margins. Like in the 5-year period, the fund delivered 31.5%, whereas category on an average and the benchmark have delivered 24% returns. Similarly, in the 10-year period, the fund's returns were almost 2 percentage points higher. But the problem with trailing returns is that they only show you returns between 2 periods of time. They fail to show if the fund has performed consistently well or not. And that is where rolling returns come into the picture. Rolling returns help us assess a fund's performance consistency over different time frames. So instead of looking at just one fixed period, in case of rolling returns, returns are calculated for multiple overlapping periods. Say 3-year returns calculated every day for the last 10 years. And then the average of thousands of such instances of returns is what we call rolling returns. It helps to remove timing bias and give a true picture of how reliable the fund's performance is. Look at your screen. The 5-year returns of the fund is in line with its category and the benchmark. But in the longer time period of 7 years, the average returns of the fund are on a higher side than that of both its benchmark and category average. 7-year rolling returns for HDFC Flexi Cap Fund stood at 17% vis-a-vis 15 and 14.5% for the category and the benchmark respectively. So we can say the fund does better in longer time frame. Downside protection risk can be a key differentiator in any fund's long-term success. So to see how the fund has performed in the tough market conditions, we compared the fund's performance with that of Nifty 500 index over the last 10 years. We checked quarterly returns of Nifty 500 over the last decade. The markets were in red for 14 quarters in the last 10 years. Out of the 14 quarters, the fund has outperformed the index only 6 times. And if you could note, most of the outperformance is after Roshi Jain took over the fund's management. Flexi-cap funds have the flexibility to invest across large, mid and small cap stocks without following any minimum threshold. The portfolio allocation is dynamic here, depending on the condition of the market. Now, if you look at the table on your screen, you'll notice some clear shifts in HDFC Flexi Cap Fund's market cap allocation over the last few years. Since May 2023, the fund has consistently kept its large cap allocation below 75% compared to over 90% in May 2020. You can see that the fund has maintained large cap allocation below 75% for the last 2 years and reduced mid cap allocation and increased small cap allocation. Mid-cap exposure has been gradually reduced from 15% in May 2022 to just 3.4% in May 2025. At the same time, small-cap allocation has increased, almost doubling from 5% in 23 to nearly 10% in 2025. But the most noticeable shift is in the cash and cash equivalents. Now, during Prashant Jain's tenure, cash levels were typically under 1%, for example, just 0.75% in May 2021. But under Roshi Jain, the fund has held significantly higher cash, reaching over 9% in May 2025. This suggests a more cautious or tactical approach, possibly to manage volatility or wait for better investment opportunities. Now, to gauge the strategy better, alongside the market cap allocation of the fund, we checked the turnover ratio of the fund. Portfolio turnover ratio shows how frequently was the portfolio churned during the last 1 year. A portfolio turnover ratio of 100 means the entire portfolio was changed over the last 1 year. Look at the data on your screen. In May 2025, HDFC Flexi Cap fund had a turnover ratio of 28.23%, meaning 28% of the portfolio's holdings were changed in the past year. This shows that the fund manager follows a buy and hold approach. But if you look at 2024 and 2023, the turnover was higher, around 42 and 40%. So why the jump? It is likely because of the fund's change in allocation in mid and small cap stocks, which naturally involves more churn during those 2 years. Apart from these 2 years, the turnover ratio has mostly hovered around 30% or less. Now that we know the fund's history and scale, let's take a closer look at where it is actually investing and what the portfolio tells us about its current strategy. The fund holds 53 stocks in its portfolio compared to the category average of 60 stocks. The fund invests 52% of its assets in top 10 stocks. On your screen, you can see the top 10 stocks of the fund. ICICI Bank, HDFC Bank, Axis Bank are the top picks. Now, if you go by the sector allocation, banking, auto and healthcare stocks have the highest allocation, marking up to 60%. So coming to the big question, should you invest in this fund? Well, to sum up, HDFC Flexi Cap fund has not only delivered strong long-term returns, but has also evolved significantly under new leadership. While its historical performance speaks for itself, recent changes under Roshi Jain suggest a more active and responsive approach to market conditions. Whether you are a long-term investor looking for stability or someone seeking growth with flexibility, this fund offers plenty to evaluate. But as always, invest only after assessing your goals, risk appetite, and after doing your own research. And before we end this video, let me remind you this video was made for educational purposes only. Don't treat it as our recommendation. Hope we have shared enough details about the fund with you to evaluate for yourself if it fits your portfolio or not. And with this, we have come to the end of this video. If you have any questions, drop it in the comment section. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.